before we start, I'm going to jump into a quick intro. We have two guests today. We have Zacharia George from Launch Africa. I'm going to give him mic in a few minutes, in a few seconds to introduce himself. And we have Sapna Shah from Novastar, both in the field of VC. So we will go through a quick run of our chat Q&A. We'll talk about 4 main topics for today. The topics are as follows: do's and don'ts of investing in African ventures, how to raise funds, investing in startups, how to identify bullish startups. Those will be our main topics. If you don't mind, I would love to for the audience to share in the chat. If you were sitting in front of Google and Google has your Google keywords, so coming to the session today, imagine it's not a session, you're going for the same purpose to Google, to ask Google, which keywords would you be asking Google? Were you typing in Google? So if you can type in the chat, which question will be asking Google as an expectation for learning today. I'll give you an example. My keyword here today is top trends in Africa. If you can share with us so that you can give us a bit of an insight for our speakers to understand the mindset of the room itself. Rafish, I'm waiting for you to type. Huh? Coffee trend, coffee startups. Okay, coffee is always coffee. Opportunities in Africa. I like that, Nikhil. And welcome, Nikhil, to Mappa Bridge. Any more keywords? And investment temperature in Africa, capital opportunities. Thanks, Eric. Thanks, Arnold. Startup in Africa. I would add from my side aftercare services to startups from the VCs, early stage investing in Africa. Guys, keep them coming on into the chat itself, framing especially organic farming in Africa. Thanks, Sija. One more question. I will leave it to you to share your things in the chat itself, and this will help us understand your mindset as well. Fintech startups in Africa is that thinking about investing in Africa, or thinking about raising cash in Africa. What are the worst fears that you have, or what are the best outcomes that you will be looking for? Today, you wear the hat of either the person investing in startups or the person who wants to raise cash. What are your best outcomes and what are your worst fears? If you can share with us, I'll give you 30 seconds to think about that, and then just type it in the chat. Investing when I make a return. Keep them coming in. How to have the right partners. Okay. Before we board Zach, I'm going to give you the mic, quick elevator pitch about you, and then we'll give the mic to Sapna. Thank you, guys. Keep the comments coming in, and we'll keep our eyes on that, and we'll try to influence our chat from this. And if you have any questions, also keep them there in the chat. We'll leave the last 10 minutes for questions. Zach, mic is yours. Elevator pitch. Burj Khalifa. You're in the ground floor. You're joining us in the elevator. Who is Zacharia George? Apart from having a beautiful voice, huh?
Thank you. Good afternoon, good evening, good morning, everyone, depending where you are. Zach George. I'm a managing partner at Launch Africa Ventures, which is one of the top early stage venture capital funds on the continent. The most prominent and most active VC fund on the continent. Prior to that, was a co-founder of Startup Bootcamp, which is the most prominent accelerator program for tech startups on the continent. Ex-investment banker for my sins at Lehman and Barclays in New York. Stanford MBA, half Indian, half Persian, father to 3 kids, musician, and art lover, I suppose.
And guys, if you Google Zach's name in Google, and you don't be surprised of having nice clips as well, apart from nice details of the VC and his past interviews. Thanks, Zach.
I've got a few albums on iTunes and Spotify, but they don't pay me anything close to what VC does. So hence the reason why VC makes a lot more sense.
I think I like a quote that you've used, that you're a musician with love to spreadsheets.
Yeah, I'm a musician that knows how to handle spreadsheets. Yeah, so.
That's cool. That's artistic. That's quite artistic. Thanks, Zach. Sapna.
I don't think I can beat Zach's interesting hobbies and passion around music. Good afternoon, everyone. Good evening, good morning. Really nice to see all of you. I'm Sapna Shah. I'm a partner at Novastar Ventures. We are a venture investor investing in disruptive, innovative businesses, high growth businesses in East and West Africa. I'm based here in Nairobi. Prior to this, I was an impact investor at Acumen. And a banker for my sins in the UK, the US, and Jordan in the Middle East. The bit that I do really want to share with you right now is I am an EO member as well. I am an EO spouse. Ritesh, who is here on the call, the current president of the MEPA chapter, is my husband. You guys can decide who has the more interesting job, venture or coffee. And I am an active member of an EO spousal forum. So please, feel free to ask the difficult questions, and I will do my best to answer at the 5%.
Interesting. Thanks, Sapna. Sapna, we'll do it in an EO format a little bit. So in EO, we have those present dive deeps, and we go for background, kind of situation, and future options. So before we start, a bit of a background, a factual background about Africa, about the scene in Africa. Which scene are we playing in? If you may share with us a bit of facts about the continent itself, and then we'll give the mic to Zach as well.
Sure, I can start with a few facts about the investing scene in Africa, especially sort of the early stage and growth scene. We are seeing a huge interest in investing on the continent. The continent has raised $4 billion of capital in 2021. In fact, that is as of the 1st of December 2021. So we'll see that number rise. And that compares to about $1.5 billion of capital in 2020. So that is a real exponential rise. And it's really exciting. It means that the world is finally seeing what opportunities and growth there is here, and how exciting our markets are. The hottest regions or countries on the continent, as you guys can imagine, the first is Nigeria. That's attracting the largest amount of capital. The second is South Africa. The third is Egypt. There's a lot happening in Egypt in terms of the investment space. And then the fourth is Kenya. The sectors that are attracting the most capital, I saw somebody put on the chat, asking about fintech. It is fintech that's attracting the most amount of capital at the moment, but you are seeing capital coming into all other sectors, including education, e-commerce, etc. Finally, and this is not a fact, maybe this is just a bit more sort of in terms of emerging themes on my mind. It's about, how do we really raise the ability for people to be angel investors in Africa? We need to see different levels of investment across the continent, from angels to large $20 million deals, $30 million deals. There's a lot more in terms of investment in green and climate. And that is something that's happening across the world, and we'll see that more in Africa as well. And overall, this becomes a conversation in many forums. There's a rise in terms of the number of unicorns on the continent. And there's a hot debate about valuations as well. Now, if any of the terminology I'm using, is not clear, please just ask, and I will do my best to.
I'm going to ask explicitly about that, Sapna, because we're mainly we're an environment of business owners mainly,
Yes.
so we're entrepreneurs, and sometimes we get lost with terminologies. I'm just going to ask for Zach's view on this, and then we'll come back for you to explain to us the terminologies before we start. We dive deeper. Zach, mic is yours.
Yeah, sure. I mean, listen, I think Sapna has done a great job of covering all the high-level stuff. So, number of investments. So, not just have the amount of investment. I mean, so when I first came to Africa 11 years ago, there was less than $20 million of venture capital, and as Sapna said, it's now at more than 4 billion. So, from a growth perspective, Africa is the largest or the fastest growing market in the world from a growth and VC perspective, right? And this year alone, we've had more than 700 funds and angel groups invest on the continent, which is, and interestingly enough, more than half of those are on the continent. So it's this assumption that most of the VCs and angel groups investing are foreign is actually not true. And the 4 billion includes more than 800 deals. So there's an increase in volume as well as number of deals. The average size of each round has gotten bigger. The number of deals has gotten bigger. And what's interesting is historically Series A, B, and C, which if terminology I think most of you get is later stage venture capital, used to make up the vast majority of venture capital. So more than 90%. What we've seen very attractive the last couple of years is there are a lot more VCs doing deals at the seed and pre-seed stage, which is music to our ears, because ultimately this is a relay race, right? Everyone sticks to their lane, and if you don't have activity at every node in the mesh or every mesh in the node, it gets broken, right? So to have good Series A opportunities, you need to have good seed funds. To have good seed funds, you need to have good accelerators. To have good accelerators, you have to have good incubators. So finally, after almost 7 to 8 years of doing this in the continent, folks like Sapna, ourselves, and other VCs have now perfected the actual, the cycle is more efficient, right? And that's arguably so much more important than just high volumes, which is great, by the way, but everyone knows your roles, and valuations are also evolving accordingly. And I think that's another key takeaway that you guys as EO members should appreciate.
Interesting. Zach, before we dive deep into this, Zach and Sapna, a very quick explanation about what is pre-seed, what's seed, what's Series A, what's Series B, if you can classify it for us. Sapna, you want to jump in?
I can do a general one. Zach, you may have sort of more specific classifications, but I think if you sort of, there's labels for all of these, but overall, the way to think about things is where is a business or a startup in its life cycle? And so, is it still at the idea stage where, there's an entrepreneur that sort of has an idea on a piece of paper, hasn't started, and needs funding for that? Is it at the stage where, they're trying a few things, they're testing the market, they've got a minimal viable product out there that they're sort of seeing, does it actually work? That's the next stage.
And this is a seed stage. So previous one was a pre-seed, and this one is seed.
That's pre-seed.
I would say this is still pre-seed. Zach may differ, but I would say that's still pre-seed.
Hey, it's pre-seed. Yeah, absolutely.
Yep. And then once you sort of think, okay, I've got something that works, right? I need a little bit of capital to say, right, like I need to do more, I need to make the product better, I need to expand my market slightly. Then that's the seed where you're actually going out to test, you're starting to get revenues from your customers. And then once you're sort of saying, actually that works, the unit economics work, we're still going to be EBITDA negative, but actually we can sell this product or service in a way that makes sense. Let's scale. And then that's when A and B comes, and that's the different levels of scale. Yeah.
And just for the info, A and B, what are the levels usually? So how much is the amount that would be invested in an A series company? For you guys, what are the tickets?
So each geography, I think, attracts different amounts, and we're seeing that change all the time. So when we started at Novastar in 2014, we sort of saw in East Africa Series A rounds for perhaps like $2 to $3 million. And Series B rounds sort of between the 3 and 10. We're now seeing Series A rounds for about $5 to $10 million, especially in Nigeria. So it is a reflection of where the market is and what geography you're in. If you're looking at the US, you may find Series A rounds of $10 million in Silicon Valley. So I don't think you can label the round by the amount raised. It's more about the stage of business you're at.
And of course, you have extremes. Like, I mean, there are a couple of companies in Sapna's backyard in Kenya that, you know, Market Force is raising a $20 million Series A round, right? Kuda did a $27 million Series A round. So as VCs, all we can do is give you ranges. There are always underperformers and outperformers. So I think Sapna's point of sticking to the stage of your business is a lot more important than just labels. You know, Telda in Egypt is a digital bank in Egypt that's pre-revenue and pre-product, and raised $5 million from Sequoia at pre-seed. So, you know, the short answer is, how long is a piece of string, right? So the key thing is, I mean, listen, I think we're getting into further questions here, but what do VCs look at different stages from a product, traction, team, market size perspective? And based on those answers, you can start to have, you know, justifiable answers. But yeah, it's also important to talk about metrics, because not every startup or sector, you know, relies on revenue as a metric or EBITDA as a metric. It is so different in depending on not just sectors, but subsectors, which is why not everyone is a VC. Being a venture capitalist is a bloody hard job, because even within a certain sector, you've got so many different metrics to look at, and really good VCs hire specialists that understand metrics for each sector. So for example, within the fintech industry, if you're a digital bank or a neobank, you are not typically valued on your revenue. You're valued on your monthly active users, right? Usually that ranges between $500 to as high as $2,000 per monthly active users. So if you look at, for example, Nubank that just IPO'd on the NYSE last week, or a Monzo or a Chime, or back in Africa, Kuda Bank, your monthly active users dictate what the lifetime transaction value of a customer is. But if you're in the fintech industry, but not a digital bank, but you're a payment gateway, like a PayFast, which is owned by DPO, or a Peach Payments, for example, you're valued on your average transaction volume each month, right? But if you're, for example, a peer-to-peer unsecured lending platform, you're valued on the size of your loan book. So it is not easy being a venture capitalist, I want to say, because it's different metrics for different focus. And this overemphasis on, I have to make a lot of EBITDA, I have to make a lot of revenue. Well, it depends what industry you're in. So the short answer is it depends, which is interesting.
So I will take a bit of, I think it's more clear for me personally as the categorizations and the way, I like the way we put it in and trying to distinguish between the different activities and how to look at them. I'll go a little bit backwards in terms of, you've mentioned earlier that the tier 3 major countries are Nigeria, Egypt, and South Africa. Am I right? About and the Kenya. So yeah. one part at each end of the continent, east, west, north, and south.
I would add Senegal and Cote d'Ivoire to that. You cannot. Francophone Africa is becoming a huge part of the ecosystem here. Senegal and Cote d'Ivoire accounted for about $350 million worth of deals. So I would definitely add Francophone West Africa to that list.
Interesting. So a question, Zach, I'll go for the first question. First topic for today's chat is what are the do's and don'ts of investing in Africa? So today I'm coming in with fresh money to the continent itself. And you've seen it for the past 11 years. Sapna has seen it for the past 9 years. So today, what are the do's and don'ts of investing in African ventures from your experience? What worked in the past, what didn't work in the past for you? if you may share with us. Zach, you can start while I mute.
Yeah, I mean, there are lots of someone's talking in the background. I don't know if we can just.
I'm working hard to mute them as well.
Okay.
So go ahead. They're muted.
Okay, awesome. It's such a tough question to ask. Do's and don'ts. Is it do's and don'ts for investors? Do's and don'ts for founders?
I would go more for you as Zach. What worked in the past? What didn't work in the past? Maybe that is it makes it easier.
Okay, high level. Okay, so just our fund is a very unique fund. We only invest seed and pre-seed. We don't do Series A and beyond. We come in super early. We back founders that typically have come out of world-class accelerators. One of the things that I completely do not waver from is I don't back founders where the holding company isn't incorporated either in the US, the UK, the Netherlands, Singapore, or other investor-friendly jurisdictions. So if you're purely, if your IP and your holding company is only in Nigeria or only in Kenya, it's a definite non-starter for me and our fund. I'll explain why later if people are interested, but it's kind of obvious. It's just the chances of you scaling outside and getting investor interest from world-class VCs is just not worth it if you're hyper-local. We typically invest in companies that are able to scale outside of their immediate geography within 6 to 12 months of our check. So cross-border expansion is very, very important to us. The only exception being if you're in a market like Nigeria that has 250 million people, you can afford to stay within Nigeria. It's the same thing with the US. If you're a US tech company, you can afford to be in the US for a while. And maybe Egypt as well. But even South Africa, you don't really have much of a chance if you're only in South Africa. That's one. We never back single founder companies. There's just too much risk from a human perspective, and from not just from a human perspective, you know, about the founder being run over by the proverbial bus, but it's just differences of opinion. Single founders have too much control in decision making and don't have a voice of reason to balance that out. Gosh, there are so many do's and don'ts, but I mean, I'm sure Sapna's got many, but I'll just probably add one more thing is we're very careful about backing founders that are that don't understand their market well. So as VCs, Sapna will agree with us, we probably see more deals in a given sector than founders themselves. So we often know more about a sector than founders, because founders tend to be in love with their product and their particular piece of technology. So founders that don't understand things like unit economics, margins, just trends in their industry, and aren't ridiculously smart about industry trends, we just don't back them. And if you can't explain what you do in 10 minutes and have to rely on your CFO, it's again, red flags to us. But I mean, I can go on for 2 hours about this, but I'll sort of stop.
If I would summarize from your side, it's the IP being registered out of the African continent. I think that, so that you can.
Mauritius is the one exception, but yeah, generally out of the African continent,
no single founder. I like that. No single founder investment. And the last one was financial literacy, at least basic financial literacy or business literacy, I would say.
Business, financial business.
Yeah, interesting.
Sapna, dare I say it's more than basic. And so let me just give you a little bit of context. You know, we at Novastar, we've raised 2 funds. We have more than $200 million of capital under management. And within that, we've only invested in, I say only, that's the strategy. We've invested in about 20 companies, 23 companies actually now. And so the point being is that venture investors, especially where we come from, is we are extremely selective in what we invest in. And we are taking that early stage risk, and we know that there's going to be failures. Not all of the companies will survive. And so when we are taking that early stage risk, we want to invest in companies that we see have a huge market and the potential to become very large. Now, things may go wrong along the way because, you know, the founders don't figure it out or something happens. But if they go right, we need a huge market. And that's where we come in and view things as the problem that is being solved has to be a massive problem. And the product or service that the founders are thinking about has to be for the many, not the few. It can't be niche. It's not worth, there are investors that will invest in more niche products and services, but it's not worth our while as a VC to be investing in niche products and services. It has to be a large market solving a large problem. So that's the first. And we get lots of founders or early stage businesses that come to us and say, yeah, we're solving this problem for these farmers in northern Kenya. And then when you ask, okay, where else is this problem on the continent? Not sure, nowhere else. It's like, sure, it doesn't mean you shouldn't get an investment, but you're not going to get a VC investment that is really looking for scale and the potential for scale.
Interesting. And I like the way you put it. Sapna has to be a large market solving a large problem, and it's nice. I think it gives a lot of clarity. Question from Eric on this is that what's your percentage on what's the failure ratio, failure to success ratio that you expect? This is a question to you, Sapna, and also
it's a question that gets asked a lot, and I love answering questions with questions, right? So please forgive me. Is what do you define as success, right? So is success an IPO? Is a success an acquisition? To me, success as an investor is a return.
Return, yeah.
Yeah. So how that return is made is almost irrelevant, right? So you got to figure out what is your strategy, and that dictates when you get in, what markets you get in, and when you choose to get out, and how you choose to get out. So this notion of VC is risky, only 1 in 10 succeed. We don't buy that, right? Because if that is your sole barometer, is I want my company to IPO or get sold, and I'm going to stay in as long as possible, then that does not work in San Francisco the way it works in Bangalore, the way it works in Nairobi. So it's horses for courses. As a fund manager, our metric is a return between a 5 to 7 year period. So as a result, we have a fund, as a fund, we have a strategy to return capital through secondary transactions, which is at Series A, Series B, Series C, and multiple rounds in between. We create liquidity for our LPs. We have 150 LPs in our fund. That wasn't a typo or a mistake. It was actually true, 150 LPs. Most of them are individuals and family offices investing between $25,000 and $3 million. There is significant liquidity because we invest super early and we typically exit at Series B and Series C. So for us, a company that does not end up listing on the NASDAQ or does not end up being acquired by Google, but has raised multiple rounds, creates value for its stakeholders, and we get a 5 to 10x exit, is a successful company. If that company fails in year 9 for whatever reason, it's still successful to us, right? So my question is always, what do you define as success? And then I can answer your question.
Interesting. So on this, Zach, I think you've nicely put it. You've nicely explained your strategy on selecting companies, and I think it's very clear that you have a clarity on your exit strategy as well. How you want to get returns on your investment, and how has so far has been your experience using the strategy for the past 11 years?
Yeah. So I've been angel investing in Africa before people knew what angel investing was. So I've had quite a few exits in my personal capacity. So I was an early investor in Flutterwave, an early investor in Kuda, an early investor in Goshgyoko. All those companies, when they do successive rounds of funding, you have the opportunity to get out early. But if you get in sufficiently early and you do a risk-adjusted evaluation of what a business is worth, there's significant liquidity. So basically what Launch Africa does now is it takes the concept of angel investing, exiting relatively early, and reusing that capital to invest in more in the next generation of companies, right? So for every Flutter Wave that launched 6 years ago, there are new versions of Flutter Waves and Yokos, and you constantly need liquid capital to keep investing. So if you're holding on to investments for 10 years, unless you've got a bottomless pit of money, which some of us do, and I'm happy for all of you that have bottomless pits of money, but those that don't have bottomless pits of money, you have to rewash your capital, which is how, if you think about it, that's how Silicon Valley VC got built. It's entrepreneurs, it's founders exiting, investing in fellow founders, exiting early and reinvesting, right? So yeah, that's a big part of our strategy. And yeah, it's not for everyone, but that's the end of the market that we focus on.
Interesting. Sapna, what do you say to this?
So Zach and Safa, we have a slightly different perspective in that absolutely we need everybody to be playing at different stages of the capital ladder. And what is really encouraging is we're seeing that on the continent, which is fantastic. But what we are able to do at Novastar is we're able to invest across multiple stages. So, we could invest alongside Zach in that seed round, but we could also invest in Series B, Series C. So just to give you guys context, it means that we can invest a $500,000 check early on, and over time, we could have $10 million invested in a company. And so sort of depending on where we are in that life cycle, it's not going to be in all of our companies, but in some. For those that we are sort of doubling down, then actually we do want to stay in till we see that big exit. So whether it is a listing or sort of a strategic purchase of the business. In some businesses along the way, we will be able to sell to someone else coming in, another investor coming in at a next round. But in some, we will want to hold and see that sort of large return. And in a way, we on the continent so far, we haven't quite gotten there. We're seeing a lot of traction towards companies raising larger rounds, raising a good amount of capital, achieving $1 billion in terms of valuations. We are just starting to see, where those exits actually come from. So some in the fintech world we're starting to see now, but it's just starting.
Sapna, we have clarity now from Zach's side about what are the criteria while selecting companies and what's the exit strategy. I think we have a clarity on what's your exit strategy. What are your selection criteria? Are they different?
It's very similar to how Zach thinks. It's at the end of the day, it's around, is it a big problem? Is it a big market? And it's very based on the assessment of the entrepreneurs and the entrepreneurial team. Adding on to what Zach mentioned, single founders are a risk because they don't have someone else to bounce off and have a check with. But it also, we know that this is a long game. You guys are all entrepreneurs on this call. It's a long game. It's a hard game, but also the types of entrepreneurs that we invest in want to move fast, and therefore they can't move fast on their own. They also need that second person alongside them to move fast with. At the end of the day, I think we don't focus on any sectors. It's really about focusing on what are the companies or the entrepreneurs that are solving big problems, and do they have the resilience and the grit to be able to figure it out.
Interesting. So there is the part of this equation is that today you've invested in my company. I'm a startup, and I fit your criteria. There is a strategy about my exit. What do I expect from you guys as a startup? What let's say aftercare would you give me? And is that different than Novastar than Launch Africa? Sapna and then Zach.
Sure. I can start. The first thing that I start with is I am not an expert in running your business. That's that's what you do. That's why we invest in entrepreneurs, and we don't operate the businesses ourselves. And so there's a high degree of trust in that, you know, we've made those assessments and you know what you should be doing. Where we really sort of help and come alongside you is, one is we're a sounding board for when you're thinking things through. We don't necessarily give you the answers because we're not the experts, but we can help you think things through, think through the strategy. The second is we can help you when it comes to leveraging our networks. Now, whether that is around recruitment, you know, you're growing very fast. You need to hire extremely competent CFOs, COOs, you know, whatever that is. So that's where we can help. You've just started, you're doing well, you've got 18 months of runway before you run out of cash. You need to raise your next round. We can again really support in terms of introducing you to the next round of investors that would be interested in coming in. That's where I would say our biggest value adds are, and where we're not. You know, if you're looking for somebody who can really help operate the business, that's not us, and that's not most VCs.
I'm happy, Sapna. That's perfect for me. I'm sold. From Novastar, I'm sold. Zach, what's your policy what's your policy when it comes to aftercare?
No, absolutely. Yeah, I mean, it's a little different when you're investing at the seed and pre-seed stage. And I often go, I mean, I give lots of talks about the importance of non-financial value that VCs should provide. There's a post on LinkedIn that I did about 6 months ago that I'll share with everyone. But the bottom line is, if as a VC fund you're not adding value outside of just your capital, you outright should not be in the VC business. Rather, just be an angel, right? So what are some of the things that VC funds should be doing for their portfolio companies? There are quite a few, but I'll try and limit it to the top 5. Number 1, you need to be helping your startup founders with commercial value add. If it's links into banks, insurance companies, telcos, retailers, you've got a lot more clout as a VC than as a founder. As an example, you're a startup in the payment space and you're looking to link your APIs to, let's say, Barclays or EcoBank. You can go and pitch to every single banker you know, and they'll ignore you because you're a small startup in your mom's garage with 3 developers. VC fund A goes to a bank and says, hey, we're backing this startup. We think it could be a great synergy for you. All of a sudden, it becomes a 2-week or a 1-week exercise. So you have to leverage your power as a VC with the banks, the insurers, the telcos, especially for B2B and B2B2C startups. So if you can't do that, reconsider being a VC. Number 2, startups don't have time to engage media. I'm talking not just Disrupt Africa, TechCrunch, I'm talking summits, conferences, pitch competitions. You want to be able to promote your portfolio companies as much as possible, because guess what? Founders don't have the time to do that, right? So you want to be the biggest brand ambassadors from a media and outreach perspective for your portfolio companies, right? So you save them time and money. Number 3, you don't want your founders to be spending way too much time approaching other investors for follow-on rounds or for co-investments. So as a fund, if you can introduce your founders to perhaps your own LPs, which we do exceptionally well, we allow all our LPs to co-invest with us for free. So it takes less time for founders to close out rounds, and we help them with access to follow-on capital, right? So you're always helping your founders, right? Number 4, you want to help your founders access talent. If you ask really good founders what their biggest challenges are, the really good founders will say it's not capital, it's talent. So again, don't become an HR recruitment firm, but help your founders hire the right people. If you're a fund with a massive portfolio on the continent, you have that access to talent that a lot of founders don't have. And then lastly, I would just say, once you're a VC fund and you have a big portfolio, you got to play kingmaker, which is what Sequoia, Andreessen Horowitz, et cetera, do so well, is you got to help your founders create synergies with other portfolio companies. So a simple example, we have a stake in a big payments company. We also have a stake in a direct-to-consumer insurance company. One can serve the other. And often founders don't have the time or energy to make these connections. As a VC fund, you can do that for your team. So if you can do these 4 or 5 things, there are many more, but these are the most important things, you suddenly become so valuable to your portfolio companies. And what happens with the ripple effect? These founders love you so much, they will refer world-class founders to you and say, you've done so much for me, I want you to back this guy or this girl, and you get deal flow literally on your doorstep because you've proved that you add ridiculous value to your founders. And that's what VCs should be doing, especially the ones that are investing pre-Series A, because that's where the founders need the most amount of hand-holding.
And interesting. So I didn't have that view about VCs and before entering this session, I think I'm quite sold now. There is always this fear of people coming into your business and buying, taking part of your business and sharing the steering wheel with you. We always have this fear as entrepreneurs, and we'd rather do it slowly, but in our own pace. Quick question on this: you keep on mentioning startups. What about scale-ups? People like EO members who've done more than $1 million, and now they want to expand in Africa, and they've been operating in one country, for example. Would you be interested in jumping in with that category, or what's your view on that? Sapna, and then Zach.
Yeah, I can start. I think at the end of the day, it comes back to what is that scale potential and how fast do the entrepreneurs want to go. And depending on that, it's about knowing what you as the entrepreneur want, and therefore what type of investment are you looking for. So if you are moving fast, you're doubling revenues every year, you're addressing a very large market, then yes, absolutely, the VC type of investment would be ideal. And we are looking for those types of investments, even though it's scale up rather than startup. If it's scale up, but it's more focused on steady growth, there's a good track record in terms of cash, good track record in terms of EBITDA positive business in the past, then actually you may be more interested in a private equity type of investment. They're looking for sort of more established, steady businesses. And in some instances, depending on what sort of your background is, it may also be debt. You may also be able to raise debt. But I think the key here is for you to know what you want in that expansion. How fast do you want to grow? How big a market are you addressing? And then looking for the capital accordingly and looking for the investor that will fit.
Interesting. Zach, what do you say to this?
Yeah, listen, I completely agree with Sapna. I mean, there's nothing further I think I would add. I mean, she's covered pretty much everything.
Cool. And if you would have a checklist for this, if you will leave me with a checklist, Safa, this is a checklist. Make sure that you take those boxes and come back to me. What are those 3 or 4 things that I said company delivering revenue every year? This is one of them. What are the other things? If you would summarize them. So I will remember them and keep you in mind. So prepare for myself to come and pitch to you guys.
Safa, is this for an expansion into Africa?
Possibly,
question,
yes.
Or just a general, if I'm scaling up, what should I be?
I'm operating in Cape Town. I want to expand to other cities. I have done it right in Cape Town. Now I mastered my trade. Now I want to go and replicate this in Lagos, Abuja, and Nairobi, and Tanzania, and so on. Dar es Salaam, yeah.
The first thing that comes to mind for me, I don't think I have a full checklist, but the first thing that comes to mind is how well do you know those markets? Because just if we say that Africa is one, it's not, right? And so, how well do you know the customer in that market? Is the customer going to behave in the same way that they behave in Cape Town or in South Africa? is the first thing, and demonstrating understanding about that. And then second is who's the team around you that's actually going to be able to execute this, and sort of, do you have a first-class team to do this? Those are the sort of two things that would come to mind immediately when we're talking about expansion.
Interesting. And do you have a checklist, Zach, for this?
Yeah, I mean, checklists we have a broad checklist, but we try and make exceptions for really unique situations. I mean, for example, as a fund, we have a checklist that says we will not invest in pre-revenue companies, as an example, right? But if we see a company with really unique IP serving a market that hasn't been served before, by the way, I'd encourage everyone here. I know EO members love to read, as everyone should. There's an incredible book called The Prosperity Paradox that Clayton Christensen wrote, unfortunately a year before he passed away. It talks about the most successful businesses, not just in Africa, but emerging markets being ones that create markets when none existed before, right? Incredible book called The Prosperity Paradox. So we've invested in a few companies, literally a handful, that are pre-revenue, right? But they addressed, I mean, Sapna mentioned that the target addressable market being big. What's even better than a big targeted addressable market is a non-existing market that suddenly becomes massive, right? So for example, the microinsurance market in Africa did not exist until a company called Microinsure launched about 10 years ago, right? So the concept of ridiculously low premiums, but also low thresholds on cover wasn't a thing in the insurance industry. So technically the addressable market was zero, 10 years ago. And now it's massive. So we make exceptions. We do have checklists, but you'd be amazed how often people make exceptions to those lists. So yeah, I'm not sure if that's the perfect answer to your question, but checklists are important, but always leave a certain part of your fund for exceptional situations. And you'd be amazed how often, maybe Sapna will agree with me on this, it's those outliers that you don't expect are the ones that will give you the most return.
Yeah, exactly. Zach, we're just about to make an investment in a pre-revenue business, but yeah, it's not our norm.
Yeah.
And one final question to this, and it was one of the topics that we didn't cover today, and then we're going to open it for Q&A for a couple of questions. And guys, what's your policy for identifying bullish startups? What's your policy of what's the technique policy of to identify those bullish startups? Where do you find them, guys? Where do you find them? How do you scout for them? If you have a map for that, that'd be great. Addresses as well, so we got chasing as well.
I mean, would you ask a good poker player to show his hand? No, I'm kidding. I'm kidding.
Vaguely, just vaguely.
I'm kidding. Sapna,
go east, go north.
So one of the best ways, and I know that it's easier once the fund is established or the VC is established, is having existing entrepreneurs that you've invested in refer other entrepreneurs. Zach talked about that. That's the best. It's then having other investors that for whatever reason can't invest in your business, because as Zach said, everyone's got their little niche of where they invest, but having other investors that you respect call you and say, Sapna, there's this business that I can't do, but they're really impressive. I think you would love them. Like those are the calls that I pick up first. So if you as an entrepreneur are sort of looking to get established, actually build those relationships with investors. Even if you know that they're not going to be the right for you, they will make introductions if they think that you have something that's unique. Get plugged into the entrepreneurial space. Start talking, identify entrepreneurs that you think are doing really well and are impressive on the continent, and start sort of, connecting with them. Those are some of the best ways for entrepreneurs to get in front of investors, and for us in terms of where we find our best investments.
Interesting. And Zach, what do you say to this? What are your tricks?
Yeah, I mean, an open trick that we have, it's not a trick, it's actually part of our fund mandate, is we have a big preference for companies that come out of world-class accelerators. The reason why we have that is I happen to run one of the largest accelerators in Africa for 7 to 8 years. So I know that when you invest early, you don't want to be spending time teaching a founder how to sort of perfect his or her tech, his legal. So we want, at the very minimum, we want squeaky clean companies from a legal and tech perspective. So IP, offshore, very clean opco-holdco structure. Your tech is not clunky. And then we spend most of our time on operational and financial diligence, but we don't waste time doing tech and legal diligence. The accelerators are a great source of our deals. I completely agree with Sapna. Founders have the best referrals. Often our LPs will refer deals to us, but with no offense to our LPs are VCs, so we will listen to them, but 8 out of 10, we say no, because what makes sense for an angel does not necessarily make sense for a VC, right? But we love our LPs, so we'll listen to them, but we may not act upon it, right?
And also, Zach, many times those LPs are not necessarily on the ground. So we have a context that they may not have.
They may not have, exactly.
Yeah.
And then just in terms of how to pick winning deals is I always say, as a VC, you need to have a good sense of what's happening in an industry, not now, but tomorrow and next year. So if you can't hire people, if you can't do it yourself, you need to really focus on future trends. So investing, for example, in payment startups right now, it's too late, right? You could argue that investing in drones is probably also too late, right? Because as a VC, you make exponential returns when you invest in sectors that have a lot of potential, but haven't yet been fully monetized yet. So I think having a forward-thinking futurist view on the world, and for that, by the way, you have to invest in R&D and market research, right? So good VC funds have folks on the ground that spend their time just scouring trends in industries that others may not. So those are things that we actively do, and that's why every now and again you would trade an investment into a startup that may not have a lot of recurring revenue, but has a lot of potential pilots, POCs, proof of concepts in their pipeline. And as a VC, you got to balance how you construct your portfolio accordingly.
Interesting. I think the time has flown. I don't know how. Okay, I'm a person who got so excited. I'm mapping Africa in my mind. If I want to wrap up from my side and then give you guys the mic to wrap up, we try to cover as much as possible of the questions, and maybe we're going to have a second session with you guys for a Q&A, an hour. I would be interested in one myself. So wrapping up from my side is there is a good country in each corner of Africa: Egypt, Nigeria, Kenya, and South Africa, and plus the Franco. You call them the Franco, the Senegal, and Cote d'Ivoire?
Francophone, yeah.
Okay,
Senegal, Cote d'Ivoire, yeah.
Yeah, I'm going to need a French partner for that so that he can translate. So, and I like the way you've put in your thank you very much for sharing your criteria of selecting startups. You have different policies, both of you, and you give a bit of diversity to us, and also you had different exiting strategies as well. Final words from Sapna, final words from Zach. Zach, final words from your side, and then I'll ask Sapna to conclude on this.
Yeah, I mean, final words from my side is I would say, first of all, just a big thank you to everyone on this call from EO joining. I mean, I know this is a relatively new industry. When I say new, it's only about 7 to 10 years old in Africa, the VC industry. And it just gives me a lot of courage and confidence when you have entrepreneurs like yourself that have built multi-million-dollar businesses on the continent in Africa and in the Middle East that are now investing into younger versions of yourself, which is the best way to put it. Because the smartest capital that goes into young enterprises are by founders like yours, because founders understand founders, right? So, but at the same time, as angels, it's hard for you to manage more than mean, you guys have full-time businesses to run. So managing more than 5 angel investments in any given year is hard, right? So the fact that you guys are even listening to a talk from 2 prominent VCs on the continent and are intellectually curious about how you could get yourself involved is very commendable. So I would just say thank you for being open to be part of the VC industry in some small way, shape, or form.
Thanks, Zach. Sapna, final words from your side?
Thanks, Safa. Just echoing what Zach is saying, it's a real pleasure to speak to all of you today with my VC hat on. And really, sort of one of the things that we didn't talk about is what are the highlights of this role? And it is extremely exciting to be investing in young entrepreneurs that are really figuring out how to change the way the continent works, how to help consumers on the continent, and how to create value for all stakeholders. So that's sort of the highlight of why I do my work. And I can imagine that as some of you start thinking about what angel investing could look like, that will be some of the highlights that you guys have as well.
Interesting. Thanks. On this, I cannot finish it without. Thank you very much, Zach, for today, and thanks to Sapna. I cannot finish it without pitching for EO a little bit. So we do run a competition on a yearly basis called Global Student Entrepreneurs Awards. We do a scout for entrepreneurs who are still in university and starting the businesses. They have a minimum proof of concept from their side. I would love to formally invite you as judges maybe in our competition. If I get the permission from you guys on this, is to pull you in maybe around Feb and March, and you'll get a beautiful spectrum of all the world, how the world is thinking. You can see our video on I'm going to share there's a video on us on National Geographic called I can't remember the name of that. I'm going to share the link with you later for that. EO has 35 years of experience, collective experience of more than 16,000 entrepreneurs on what appetite does the entrepreneur have in terms of learning and in terms of thinking. I would love to invite Sapna, you're with us, and Zach, we'd love to invite you to be part of that family in the future as well. Thank you very much for today, and I wish that we can have another follow-up session with you guys without asking deep questions. We're going to be making a bit shallower questions, so we don't take your poker tricks on this.
Yeah.
Thanks for that.
Before closing, I would like to thank you, Safa, for moderating, and Sapna and Zacharia for spontaneously accepted our invitation to share some of your thoughts with us today. And it was a very informative and exciting moment. Thank you very much for that. I will just, before closing, just share with you, today is our last event of this year, of this calendar year. We have already reached the end of the year, and we are starting with an event on the 13th of Jan. Alex, if you can share the flyer, and everyone can see it, with Joyce Beckwith, the first female Kenyan person to fly the hot air balloon. So she will be sharing a story with us on the 13th of Jan, and it will be our kickstart for the year 2022. And so on this note, I thank you all for your interest in the events we are doing. And I would like to say a Merry Christmas and a very, very Happy New Year coming to you and all your families. And thank you for your time. Thank you for taking the time to listen to our events. Thanks.